Hello and welcome to Morningstar. I'm Emma Wall and I'm joined today by Isabel Levy, founder of Metropole Gestion, to talk about value investing. Hello, Isabel.
Hello.
So I suppose I could start with considering the rallies we've seen in Europe, in the UK and in the US. Are markets overvalued at the moment?
Well, we don't think the European markets are overvalued because if you look back, we had a rally, of course, at the end of last year and even this year. But the fact is that for the past 4 years and from 2011, we had so many fears in Europe about the destruction of the Eurozone, about the lack of growth comparing to the American market or even comparing to emerging markets, that basically we didn't recover the undervaluation we had comparing to the American market. So it's only a start, I would say.
Value is something that can be very personal, and there are a number of value metrics that individuals use, investors use. How accurate do you think these metrics are?
I mean, we have to look at, of course, the market. Some people in the market are local to global metrics, PE, price to book. So we have to look at them, obviously. And if you look in terms of PE, the PE of the European markets are much lower than the PE of the American market right now. So I think in terms of undervaluation comparing to the American market, it's obvious if we take a global measure. Then I would differ a little bit, and choosing different measures depend on the company and the sector we're talking about. So we have to take a global approach about the market, but also a specific approach, companies by companies. So sometimes the PE for a company which is very cyclical and it's at the bottom of the economic cycle without producing any earnings, obviously the PE is very high, but it's very inexpensive because you are at the bottom of the economic cycle.
I suppose then it's a case of not being a slave to the data, because this in fact can lead to value traps which can catch out investors and mean that they lose money.
Yes, they can lose money, but it depends then on the horizon you have in front of you. When you are an equity investor, I'm afraid to say that we have to look very long term. And some people are talking about 3 years, 2 years. What is long term is all the definition about long term. But if you look at the regulators, they oblige you to write on your prospectus that long term is at least 5 years. So being an equity investor should mean that you have money for a long time and that you can wait. So this is very important to keep that in mind.
Isabel, thank you very much.
You're welcome.
This is Emma Wall for Morningstar. Thank you for watching.